Welcome to the podcast about venture capital, where investors and founders alike can learn how VCs make decisions and reach conviction. Your host is Nick Moran, and this is The Full Ratchet.
Welcome back to TFR for another edition of Investor Stories. On this segment, the experts talk about a startup that failed and the causes of that failure. Here's the segment called Mortems.
On today's special segment, we have Tim Draper. Tim, can you tell us a story about a portfolio company that failed and why it failed?
Yeah, I'm not going to say one because I tend to feel like all portfolio companies move the ball forward. The failures have usually been failures of trust. And what I mean there is that the entrepreneurs don't have enough faith in each other. Maybe there are 2 or 3 people who are starting the business and they're all overthinking each other instead of delegating because there's a lot to do in a startup. That's usually a problem. It's rare that it's a problem that they never reach the product market fit unless they're just in a science project, unless they're scientists thinking like scientists in the science project and thinking that the money they got was just a grant. So that happens once in a while. But normally, if you have a really dedicated entrepreneur who's got a great vision and who is listening to customers, listening to people, making adjustments, small adjustments all the way, and making the right decisions, that business will take off.
On today's special segment, we have Jenny Lefcourt of Freestyle. Jenny, can you tell us a story about a portfolio company that failed and why it failed?
I had a company that I invested in called True Facet, and True Facet sold high-end jewelry, like branded jewelry and watches online that were used. It was like the real, but really focused on jewelry and watches. And loved the founders. They came out, really knew their stuff in the CAC and LTV world. They really knew they had unfair advantage with their connection to the supply of a lot of the Cartiers and Rolexes, et cetera. But ultimately, and it was another VC who said this to me quite beautifully, it's blanking on the exact word, but CAC to LTV is hard enough when you have users, when you acquire them and you're getting them to use you all the time. You're going to have to sell a watch. If you're really active 4 times a year, they're going to forget you before they're even on to the next one. And so it really was a very, very leaky bucket. So if I'm ever to do consumer, I feel strongly that when I acquire or we acquire that consumer, that it's really a habitual, daily, weekly habit that you're using it. Otherwise, I think consumers forget. And they're like, oh, I sold a watch on something. Where should I sell it? And they do a Google search. So that was one that died. And I feel like that was a very good learning for me as to what not to invest in.
On today's special segment, we have Chris Sugden of Edison Partners.
Chris, can you tell us a story about a portfolio company that failed and why it failed?
I'll tell you a bunch of stories for better or worse. Our loss rates have gone way down. I can say that in the last 3 funds, but I joined Edison and Edison 4 when we were much more venture-like. I guess I always want to give more detail than less because I think real names, but I'll just sort of protect. Some of them were innocent, but there were a couple of folks around the company that didn't do as good a job as they probably should have as management and us as lead investor. I think about one in the data space, kind of data analytics, data ingestion, et cetera, kind of a little bit early for its time. It was the classic of selling to a market that was a little more niche than we all thought with really long sales cycles. And what was happening with the 2 founders who one ran product and one ran go-to-market, the go-to-market person was constantly overstating the pipeline and overstating where the deals sat. And the product person was constantly building the next thing instead of focusing on selling what we've got. So you had this double whammy. And this was back again, I think about this is an Edison 5 company. So putting in perspective is like 15 years ago. So this is all smaller dollars. But the point is, we thought we were investing in a company that was going from 5 to 12 kind of in revenue, and it went from 5 to 8, but it had set up its burn. So it wasn't like this crazy burn numbers. But if you're only raising $10 million back then, and you're burning through $10 million in a year or less, and you look up and you've only grown a little bit, now what do you do? And I think about the conversation a lot. What I've learned, that entrepreneur had all the answers. Those 2 entrepreneurs had all the answers. And we had another early stage VC that was in there before us in a really small way, like a couple $1 million. I think we both realized we had folks who they had all the answers, or any suggestion we gave at the board meeting was, oh, we tried that before. That's a bad idea, and here's why. So I think the idea of collaborating and really using your board to help you make decisions, not make decisions for you. I want to be really clear, because I think boards should be a strategic weapon in your arsenal if you're an entrepreneur. In this case, this company did not use its board wisely. And that wasn't because they didn't listen to my ideas. It was they didn't listen to anybody else's ideas but their own. And that kind of put us in a position where you sort of fire sale it because you just looked and go, this team is not going to get there. So it was a couple of things. Product market fit was off. Two founders who were doing their own thing and not really coming together to run the business from a go-to-market and a product perspective. And then just not listening when there was good people around. And this board, we actually had 3 or 4 people who were way smarter than me and had scaled businesses before. So those are, and frankly, that's again a 15-year ago-ish story. And I look at all the things I learned from that deal. You learn way more in deals that don't work out than you do in deals that do work, by the way. But you don't want to read those lessons either. But the point being, take all that and how you apply it going forward. And I think one of my visions for the Edison Edge that we talked about already was thinking about how do we actually kind of make it an integrated approach here? None of the management team thinking those are my investors over there versus kind of I've got that access to a team that can help me here in this edge. So that deal was one of the ones that kind of made me think about beyond what the one CEO I talked about that kind of had the idea. That deal made me go, we need to do more for our companies.
That will conclude this installment of Investor Stories. If you're enjoying the program and would like to see it continue, take a moment and leave a 5-star review in iTunes. Okay, that will wrap things up for today. Until next time, over-prepare, choose carefully, and invest confidently. Thanks for joining me.